This Chapter 2 examines in detail the quantitative scoring factors applied by Moody's in their approach to the restaurant sector, and how these are ultimately bundled together to derive a first estimate of the issuer's credit rating. We focus in this chapter on the Moody's approach only, since it allows us to estimate a specific rating within a notch or two from the actual one, provided we have the correct inputs and apply the suggested methodology as instructed. The Moody's 1 document identifies 4 broad rating factors that drive the quantitative part of its restaurant assessments, which are broken down into a further 10 sub-factors that carry each a specified weighting in the scoring process. The 4 key risk factors are scale and diversification, profitability, leverage and coverage, and financial policy, and these are broken down further as follows. Under scale and diversification, revenues carry a weighting of 10%, number of system-wide units 5%, revenue by geographic region 5%, and brand quality 5% again. These aggregate to 25%. Within profitability, Moody specifies first EBITDA margins, attributing to it a weighting of 5%, and second, return on assets, with a weighting of 7.5%. These aggregate to 12.5%. Under leverage and coverage, debt to EBITDA receives a weighting of 17.5%, EBITDA to interest another 17.5%, and finally retained cash flow to debt 17.5% once again, bringing the total for this category to 52.5%, which means that these key financial metrics represent more than half of the aggregate quantitative score. Finally, under financial policy, the sole sub-factor, also labeled financial policy, receives a final 10% weighting. We now turn to the determination of the rating earned by the issuer in each subcategory. Beginning with revenue, Moody's describes this subfactor as an indicator of a company's degree of success in providing a positive guest experience and maintaining its brand relevance, as well as the strength of its franchise base, new product pipeline, distribution infrastructure, and advertising budget. Moody's includes in this measure revenues generated from company-owned and operated restaurants, in addition to royalty, franchise, and initial fees from affiliates and franchisees, as well as rental income, which is substantial for a few issuers. The table appearing now links total revenues to one of 8 broad ratings categories, from AAA to CA, and is self-explanatory. So a restaurant with $5 billion of total annual revenues would be classified in the BAA category with regard to this specific subfactor, which, we remind you, has a 10% weighting within the total. Note that only the broad rating grades are used for this purpose, as with all Moody's methodologies, with no specification of the usual suffixes 1, 2, and 3. We jump a little ahead to remind you next of what Moody's would do with the BAA rating obtained by our issuer in the revenues category. In short, the rating agency associates with each subcategory rating a numerical value based on the grid appearing now, where you will note that a high rating translates into a low numeric and vice versa. The BAA sub-factor rating for our issuer therefore translates into a numerical value of 9, a number we will use at the end of this process in combination with the 10% weighting for this sub-factor to derive the final weighted average score and hence the final credit rating for the issuer. Our remaining task before we proceed to this final calculation is to summarize the scoring methodology for each of the 9 remaining subfactors on our original list. Next on this list is the subfactor number of system-wide units, in which Moody's includes those owned and operated by the company, as well as those franchised and affiliated. Moody's feels that revenues in and of themselves may not fully capture a company's scale of system-wide operations. For example, companies like McDonald's pursue franchise-focused business models, which generate a revenue base, $23 billion in 2010, significantly smaller than what its system-wide unit count would indicate at 75 billion. Conversely, a company that predominantly owns and operates the majority of its restaurants could be large in terms of revenue, but small in terms of restaurants operated. This additional measure of scale and diversification, in the opinion of Moody's, enables the analyst to capture more accurately the true scope of the rated entity's restaurant portfolio. The larger the scope, the broader the distribution across regions and international geographies, and the greater the operating leverage, purchasing power, and supply chain efficiencies. The table appearing now converts the number of restaurant units system-wide into a broad ratings category just as before, with a total above 40,000 translating into a AAA rating, a total below 50 into a CA rating, and all totals in between earning a rating between these two extremes. The third subfactor in the scale and diversification category is revenues by geographic region, which gives greater credit to those entities with a geographically diverse restaurant base, since these enjoy some level of protection against regional shocks and events, such as hurricanes or economic downturns. This measure is necessarily a little less quantitative and more judgmental than the preceding ones, with the Moody's measurement criteria using language like meaningful, material, and widely located, as we shall see shortly. The table appearing now translates the geographical concentration, defined principally by reference to the number of continents, countries, or regions within a country in which the restaurant operates, into one of the usual 8 broad rating categories. We will pause here for a moment while you examine the individual entries in this table. Last on the list for the scale and diversification category is brand quality, defined again somewhat subjectively and by means of language such as solid performance, regular, successful, reasonable, and volatile. While this subfactor only carries a 5% weighting, its importance to Moody's stems from the information it conveys about consumers' perception of the brand, as well as the frequency and success of new products, factors that ultimately affect pricing power and the restaurant's ability to increase the size of the average check. Moody's emphasizes, however, that a decrease in traffic is sometimes masked by a percentage increase in average check, a trend that may last for some time but cannot continue indefinitely when an underlying deterioration of brand strength is occurring. The table appearing now converts once again this measure, defined as you can see by reference to increases in average checks and traffic volumes, strength of product pipeline, and success of new product offerings, into a broad ratings category. We will pause here for a moment while you examine the individual entries in this table. We turn now to the second rating factor, profitability, which you will recall includes two subfactors, EBITDA margin and return on assets. Moody's defines EBITDA margin for this purpose as the ratio of consolidated earnings before interest, taxes, and amortization to net revenues. Viewing this measure's absolute level and its volatility through past economic and industry cycles as important indicators of future operating performance and how well it compares to peers. Return on assets is defined as the ratio of net profit after tax before unusual items to average assets, a measure that gauges the company's ability to generate a return on its asset base and hence provides another gauge of future cash flow generation. Moody's acknowledges certain drawbacks to the use of this ratio stemming from disparities in the reported book values caused by past acquisition activity, depreciation rates, and business model, but still sees informational value in the ratio's absolute level and historical trends. The table appearing now associates a broad rating category with the entity's EBITDA margin and ROA and should be self-explanatory. You will note how difficult it is for any restaurant to reach the AAA or AA classifications, needing an EBITDA margin of 45% or higher to achieve this. And you will appreciate the attractions of the franchise-based model under the ROA measure specifically, given how small the denominator of this measure becomes under this asset-light approach. The third rating factor, leverage and coverage, includes three subfactors you will recall: retained cash flow to debt, debt to EBITDA, and EBITDA to interest. The first of these, RCF to debt, is defined as the ratio of funds from operations less dividends divided by debt, and represents a good indicator of the company's financial flexibility because it measures how quickly debt could be repaid after current period fixed cash expenses, including dividends, have been met. In addition, the absolute value of retained cash flow is an indicator of the company's ability to cover its working capital and investment spending needs. Next comes debt to EBITDA, defined as total debt to earnings before interest, taxes, depreciation, amortization, whose principal advantage is its ease of use for comparative purposes since it eliminates the impact of different business models that drive different levels of depreciation, as well as financing decisions that impact interest expense. We remind you in this context that Moody's adds to the reported debt figure an amount equal to 8 times the annualized operating lease payments, which it views as debt-like for analytical purposes. The third measure, EBITDA to interest, is defined as the ratio of earnings before interest, taxes, and amortization to gross interest expense, and measures the borrower's ability to cover the cost of borrowed money. Once again, Moody's adjusts the reported figures here for operating leases, treating 1/3 of the annual rent expense as interest expense and the other 2/3 as depreciation expense. The table appearing now converts each of these three ratios into one of the 8 broad rating categories. The reference to gross interest expense means that the aggregate amount of interest paid by the borrower is used, rather than the common measure of net interest expense, which offsets a company's interest payments against its interest revenue from fixed income investments. The last of the 10 subfactors is financial policy, whose definition, like a few of the earlier measures, is more qualitative and judgmental than quantitative. Its role is to assess the expected impact of strategic and financial decisions on future credit quality and management's overall tolerance for risk. An especially important consideration for restaurant companies, given external risks such as health concerns and food safety that could negatively impact earnings and impair brand image unexpectedly. More generally, for Moody's, the company's financial policies provide guidance to management's tolerance for financial risk and its commitment through economic cycles to balancing the conflicting interests of shareholders and creditors, including the likely direction of its future capital structure, its use of dividends and share repurchases, and its reliance on acquisitions and how they are funded. The table appearing now assigns one of the 8 broad rating categories to the company's financial policy. You should take note of the focus on the company's reliance on internal sources of funding, the level of its free cash flow after share repurchases, acquisitions, and capital expenditures, its commitment to a high credit rating, its balancing of shareholder and creditor interests, its access to funding under a bank credit facility, and finally whether that facility is secured or unsecured, and the tightness of its covenants and remaining cushion under those covenants. Having completed the determination of the individual ratings for each of the 10 subfactors, the remaining steps in the quantitative part of the credit analysis should be familiar. Step 1 is to combine the individual sub-factor ratings with their individual weights to obtain an overall weighted average score for the company as a whole, again by means of the table you saw at the beginning of this chapter, reproduced here for convenience. We will illustrate how this works for Starbucks in detail in Chapter 4. All that remains is to reproduce the final table from Moody's 1, which converts the weighted average score into the overall rating, at least with regard to the purely quantitative part of the analysis. You'll recall in this table the presence of the numeric suffixes, enabling the rating agency to differentiate more finely than before within its broad rating categories. Again, this will be illustrated in detail for Starbucks in Chapter 4. As we have mentioned, Moody's rated 33 restaurant companies as of the date of the Moody's 1 document, with final senior unsecured ratings ranging from A2 to CA. That document provides the individual subcategory ratings for 10 of these companies, some of which bear a little commentary. The table appearing now lists in the first column the names of the individual restaurant companies, with their senior unsecured rating appearing in the second column. Note that only one of these companies, McDonald's, was rated overall above the BAA category. The remaining 4 columns show the individual ratings for each subfactor in the scale and diversification category. Moody's provides virtually no commentary about any of these ratings in this document, but elsewhere in its public research, it makes a couple of observations worth repeating, particularly with regard to the so-called outliers, defined by Moody's to mean subfactor ratings that are 2 or more grades higher or lower than the entity's overall rating. Note in particular the 3 positive outliers are identified in each of the system-wide units and the revenue by geographic region subcategories. This should not be surprising given the extraordinarily global scope and size of some of these entities, such as McDonald's, with its 32,000 restaurants worldwide and excellent diversification of revenues across several continents and in numerous countries around the world. In case you are not familiar with some of the names, by the way, Yum Brands is the owner of Pizza Hut, Taco Bell, and Kentucky Fried Chicken. Darden owns Red Lobster and Longhorn Steakhouse. Brinkers owns Chili's Grill and Bar, and DineEquity owns International House of Pancakes and Applebee's. With regard to profitability measures, it is apparent that margins are generally weak at virtually all companies, with the EBITDA margin subfactor rating in 6 cases lower than the overall rating, and only one company squeezing into the investment grade category. This reflects the intensity of competition and the sustained pattern of promotional discounts by many operators, along with the general increase in food prices at a time of diminished consumer spending power. And with regard to leverage and coverage and to financial policy, ratings for which appear on this slide, we highlight in particular that the subfactor ratings for return on assets and for debt to EBITDA are generally solid and frequently higher than the entity's overall rating. This reflects the moderate leverage of most entities and the asset-light business formula that results from extensive use of franchising. These remarks are reproduced here for your convenience. We complete this chapter by examining the other rating considerations cited by Moody's in the document Moody's 1, but not explicitly incorporated in the 10 subfactors we have been analyzing. Moody's acknowledges a trade-off between simplicity that enhances transparency and greater complexity that would enable its grids to map more closely to actual ratings. It also emphasizes that its ratings incorporate expectations for future performance, while the information used to illustrate the mapping process is mainly historical. Expectations for future performance may be based on non-public information obtained from senior management, or by extrapolating from past performance, industry trends, expectations for the likely range of future supply, demand, and prices, competitor actions, and other factors. These may turn out to be inaccurate as a result of unanticipated changes in the macroeconomic environment and general financial market conditions, industry competition, new technology, regulatory and legal actions, and management appetite for acquisitions, disposals, or share buybacks. Other important factors left out from the 10 rating subfactors include the quality and experience of management, corporate governance, and the quality of financial reporting and disclosure, because the assessment of these factors is highly subjective, and ranking them by rating category in a grid would suggest more precision than is realistic. Quality of management is evaluated via meetings with senior executives that shed light on business strategies, policies, and philosophies. Once established, a record of consistency provides the rating agency with insight into management's likely future performance in stress situations, and can be an indicator of management's tendency to depart significantly from its current business philosophy. Corporate governance includes audit committee financial expertise, the incentives created by executive compensation packages, related party transactions, interactions with outside auditors, and finally, ownership structures. Accuracy of financial reporting depends on strong internal controls, including centralized operations and a proper managerial attitude and consistency in accounting policies and procedures. Additional factors that are difficult to quantify or that have a meaningful effect only in some instances in differentiating credit quality include regulatory, litigation, liquidity, technology, and reputational risks, as well as changes to consumer and business spending patterns, competitive strategy, and macroeconomic trends. Inclusion of these factors in the grid, however, would make the grid excessively complex and substantially less transparent, according to Moody's. We conclude this discussion of the Moody's methodology for restaurants by bringing to your attention the significant differences in methodology between the Moody's 2 document, which was dated June 2008, and the Moody's 1 document, which came along in June 2011, so 3 years later. The table appearing now lists the risk factors appearing in the 2 documents, with their weights under each of the 2 documents appearing below. Greater weights are now assigned to classical metrics from ratio analysis, such as RCF to debt, debt to EBITDA, and EBITDA to interest, each of which is now weighted 5 percentage points higher than in 2008, while certain factors like free cash flow to debt and average unit volumes have been eliminated altogether, and others have seen their weights reduced. Moody's does not comment on the reasons for these changes, except to say that the 2011 report reflects the same core principles as the June 2008 methodology, but incorporates refinements in Moody's analysis of the key credit fundamentals of the industry. A quick examination of the changes reveals that the most significant result is the very large weighting increase in the risk category leverage and coverage from 42.5% previously to 52.5%. Essentially increases the analytical focus towards traditional debt servicing capacity metrics and moves a little away from factors that are more indicative of business risk generally, such as brand-related considerations and the growth in same-store sales. This is perhaps a consequence of the criticism leveled at the credit rating agencies during the financial crisis and the allegations that their ratings criteria were insufficiently transparent and unduly subjective. This completes Chapter 2 and also Part 1 of this module.